Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're talking a little bit about a rather tender issue, and of course we're speaking about the NCB Financial Group's offer and takeover bid for a majority stake in Guardian Holdings Limited. And this takeover offer comes to a close in a relatively short period of time on February 7th, so just around 2 weeks to go. Now, looking at some of the details and some of the factors that investors should consider in whether or not to tender their shares, taking a look at the history of the deal, there was an initial offer which was put forward back in November of 2017 to GHL shareholders, in which NCB would have been targeting a stake of just over 50% or controlling interest and up to 62% of the shareholding of Guardian Holdings Limited. And this offer price put forward to shareholders back in 2017 or towards the end of 2017 was just around US $2.35 per share. Now, there were a couple issues related to the particular offer, and it was inevitably stalled. And ultimately, a revised offer came forward and was put forward for investors, and that revised offer again is for that 50% or 50.01% to 62% shareholding, but at a revised price, some almost 19% higher at US $2.79, which works out roughly to just around $19 or just under $19 TT equivalent. Now, some important dates for this particular offer. The 20th of January, which is actually today, is the last day that you can acquire shares and be eligible to accept this offer. Why is that? Well, the record date is the 31st of January for eligible shareholders, and shareholders have until the 7th of February 2019, so that's next week Thursday or thereabouts, to accept the offer and submit their tender acceptance documents. Now, some of the key questions: will the offer be successful? Well, on the face of it, it would certainly seem so. Currently, NCBFG has just around 29.99% of the shares of Guardian, and they intend to seek a minimum shareholding of just around 50.01%, as you can see by that dashed blue line. Now, two of the major shareholders or key shareholders have indicated in the latest director's circular that they intend to or have already accepted the offer. And those two key shareholders own just over 21.8% of shares remaining in Guardian in terms of the free float, which should take the total shareholding of NCBFG over the 50.01% threshold. And as mentioned previously, NCBFG is seeking a maximum shareholding of just around 62%. So again, it would appear very likely that this deal is going to be successful. Okay, so it's going to be successful. Is the offer price a fair one to shareholders? Well, let's take a look at some of the valuations that have been put forward over the past couple of years. Now, in May of 2016, on acquiring that 29.99% stake from key shareholders, the offer that was put on the table and accepted was just around US $3.24 per share. Now, importantly, that offer price was not made available to all shareholders. However, in November of 2017, the $2.35 US price was put forward, and at that time a valuation was done by Ernst & Young, and that put the value of Guardian holding shares between $2.53 to just around $2.90. So at that point in time, the offer price was just a shade below the suggested valuation range by Ernst & Young. Fast forward to 2019, and Broadspan Capital was engaged by the board of Guardian Holdings Limited to conduct its own valuation. And at that point in time, a very recent valuation actually in January of 2019, the valuation was just between $2.76 US per share to $3.35 US per share. And the revised offer price, as we can see, is just around $2.79 US per share. And important to note, this Broadspan valuation base case was based on a dividend discount model, which is more suitable for companies with very predictable or reliable dividend streams and in a more mature stage, typically, of their growth cycle. If we look at another valuation model that was included in the Broadspan valuation document, which includes trading comparables, that would put the value of the share or the suggested range somewhere between US $3.89 to US $4.76 per share. Now, arguably, this may not be the most reliable valuation, given that some of the comparables there are not like for like in terms of the business that Guardian Holdings Limited engages in, and they include some larger financial companies, banking holding companies, etc. So at $2.79 and relative to the base case broadspan valuation, it would seem that the offer price is within what could be considered to be a relatively fair pricing. Now, should investors accept or not accept the offer? Well, any investor's decision to accept or not accept would depend on their individual circumstances, but here's somewhat of a checklist to help you in making that decision if you are still undecided. Now, under the accept camp, some of the factors that might drive you to make this decision would be whether or not you are uncertain of the takeover benefits and that should or could aid in future growth of Guardian Holdings, whether or not you have concerns about the Guardian Holdings share price post-offer, meaning that when the offer lapses or closes on February 7th, whether or not you believe that the share price will fall, if you would like to partially reduce your holdings of Guardian Holdings shares, and of course, one of the major drivers, whether or not you would like to receive US dollars for an asset that you would have likely purchased or would have purchased in TT dollars at some point in time. If that's the case, then you would want to tender your shares, and there's a very defined way of going about that. Contact your personal broker for more information. Now, if you may not want to accept, some of the drivers for that decision could be if you believe in the future growth prospects of Guardian Holdings with this acquisition taking place, if you believe the shares are undervalued, and as we mentioned, one particular valuation range put the share price at between $2.76 to $3.35 US a share, and there was another which was, although somewhat less of a comparable, placed the value of the shares at a much higher range. And of course, if you do not really need US dollars for a TT dollar asset, then you could either hold on to your shares or, the less likely decision, sell them on the market at this point. Now, if you do choose to tender your shares, what would be the acceptance ratio? In other words, for every 100 shares, let's say, how many of these will be accepted? And much of this has to do with the total level of subscription or acceptance of the offer put forward by NCBFG by all other remaining Guardian Holdings shareholders. Now, back in 2017, just around 91.74 million shares were tendered, and that would have resulted roughly in an 80% acceptance ratio. Put differently, just around 80 of every 100 shares that would have been tendered by an investor would have been accepted, and you would have received US dollars for it. Now, if the total number of shares tendered in this particular offer is between 46.4 and 74.23 million shares, then investors should get a one-for-one acceptance or 100% acceptance. However, on another extreme, if every single Guardian Holdings shareholder at this point in time tendered their shares, which would be a subscription of just around 162.35 million shares, that would result in just around 45.7 of every 100 shares you tender being accepted. As mentioned, in December of 2017, just around 91.74 million shares were tendered, and that's at a $2.35 price. At a $2.79 price, it's likely that more shares will be tendered, meaning that that acceptance ratio should be a little bit lower. So some things to think about. The last trading day again for Guardian Holdings, if you would like to be eligible for this offer. That's it for this week's edition. For more information, give us a call at 226-8773 or 2BORSE. Email us at invest@boursefinancial.com or visit our website at bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.